This is True Multifamily, the show where we dive in on what really happens after closing a multifamily property. We're going to expose the role of asset manager. That's a person who has the responsibility of seeing the vision, executing the plan, and managing people, budgets, and timelines, all to deliver returns for our investors. These are the real struggles, the real victories, and the real stories of asset management.
Welcome back to another episode of True Multifamily. I'm your host, Justin Fraser, here today with Anton Mattli from Peak Financing. Peak Financing. Anton, thank you so much for coming on the show today.
Hi, Justin. Thanks for having me on.
I'm grateful you came on the show. And, lending, financing, getting money for our properties is something that we normally talk about going into a deal, of course, right? We need money for our deals. But, today you and I are going to talk about how you can help me as I own my deal, as we prepare for refinances, as we prepare for selling. Not, I think, spoken about enough, and something that I'm personally going through on a few of our properties right now. So I definitely want to get into all of that with you. But first, Anton, give us a little bit of an overview on who you are and what your company does.
Sure. I'm a co-founder and CEO of Peak Financing. We arrange financing for commercial real estate with a strong focus on multifamily properties. And within that segment, we focus primarily on as we call it, the middle market segment, which typically includes property from 2 million in asset value up to around 50 million. Above that, it's mostly institutional players that have their own in-house staff that do exactly what we do when we help our clients. So that's our focus. I'm based in Dallas, Texas, but we help borrowers all across the country. That strange accent, even though I'm based in Dallas, is from Switzerland. I was born in Switzerland. Right after school, I joined the investment bank, worked for UBS in New York, Tokyo, and Hong Kong. And after I left banking and helped family offices with their direct investments, including commercial real estate, which really was the reason why it brought me back to the US. And that's why we are based here in Texas.
Gotcha. Okay. Wow. So you mentioned the middle market, 2 million in property value, right? Asset value to, you said 50 million.
Roughly, yes.
Roughly. Okay. And nationwide, right?
Yes.
Okay. Wow. So how does, take me through an example of, from before the deal through, how do I need a loan. I've identified a property. When do I call you? Should I call you before I have the property? Like, how does the process work? What is the best way for me as an operator, as an apartment buyer, to work with someone like you?
Yes, so I think it's important, right, that you realize as a buyer, whatever you receive up front is just the beginning of your whole path of ownership, and you want to prepare yourself in the proper fashion. And as you know, you need to raise equity to get the deal done, unless you bring all of it by yourself. But even if you bring it yourself, you need to be acutely aware of what the debt side is going to look like, because it is going to impact your returns. So the first step really is once you realize this is a good deal, I think I want to make a run for it. Typically, you already have your debt assumptions made well ahead of time when you do your initial underwriting. What we recommend is once you say, this is a good deal, I think I want to make a run for it, that you reach out to us so that we can validate with you your debt assumptions, so that you are confident when you submit that LOI that what you think you can get in debt and all the various terms of that debt piece, that it's actually achievable. Not that you are already make the wrong assumptions and then you have to readjust later on once you have a signed PSA and potentially have to retrade, right? And as you know, retrading is a big no unless there are hidden issues, right?
Yeah.
With the property. So that's why we recommend to start out before you submit an LOI, that you get that level of confidence.
Okay, so I've identified a property that I like. Now, as you know, things tend to move pretty quickly in that sort of phase of from finding the property to getting it under contract. I always feel like it's a mad dash. It's a sprint, right? So we're sprinting in 100 different directions to try to be the one that can validate our assumptions, can make sure the property itself is good, the area is good, and that financing can take on this property. So how so I send you some information. What information do I have to send you so that you can give me good confidence in the debt terms that I might be able to get?
Yeah, sure. It depends a little bit whether it's a stabilized property or non-stabilized property. If it's a stabilized property, all what we really need is a T12 and a rent roll at the property level. If it's an official listing, the offering memorandum helps, but it's not really necessary. That's on at the property level. Obviously, if we are new in a relationship, we also would need to see your bio. We need to see the PFS and REO schedule of all the partners that are ultimately KPs and guaranteeing the loan. So that's all what we would need. If it's a distressed or non-stabilized asset, we also would need your CapEx budget as well as your 3-year pro forma, because then we are not only looking at how well the property cash flows currently, but how well it would potentially cash flow once it's fully stabilized. So we need to underwrite that bridge loan or whatever other loan it might be to that exit in 3 years from now.
Got it. So you can help me find a bridge or a stabilized agency type loan.
That's right. Yes.
Excellent. Okay, great. So the T12 obviously being most important, we get financials from the brokers, of course. We have our own underwriting, and somewhere in the middle is the truth usually. So what is it that you're looking at when I send you a T12 or a broker's OM that you're probably going to start ripping apart, and what should I be concerned of when I'm looking at those numbers?
We look at the most recent 3 months of rent collections, the closest on the income side. Obviously, we look at T12 at the last 12 months of other income. So, but the last 3 months of rental income is really the crucial piece. And then we also ripped, as you called it, the expenses apart, right? So whatever the broker is telling us and the buyers in their OM doesn't really matter, particularly in markets like Texas and some others where property taxes tend to increase significantly once you buy a property. So we essentially normalize the expenses to what we believe a lender, and really behind the lender, the appraiser will underwrite to, right? What people do not understand is that a lender can come up with any type of expense underwriting. Ultimately, it's the appraiser that has to agree to it, right? The appraiser is essentially the independent party that makes sure that the lender is not just randomly underwriting, but to realistic numbers. So that's really the important part. But we also look at that, particularly again when it comes to rental income and negative trends. How does that look like compared to the rent roll? And particularly over the last few months, we have seen major movements in collections. Mm-hmm. We want to see the most recent T12 and most recent rent roll, right? We see still, unfortunately, deals that have outdated T12, outdated rent rolls that are maybe 2 months old. It's very hard to underwrite to this because we really want to give you confidence that the property trend is still in the right direction. So we can quote you anytime based on any T12 and rent roll, but it doesn't really help you as a buyer if you do not really have confidence that that trend of T12 income and rent roll performance continues.
Got it. How have things changed over the last 12 months with COVID-19? We're recording this here in early 2021, so we're just about a year into this pandemic. I know in the beginning, basically nobody was lending for a brief period, and then things started to open up again. But how has that changed your underwriting and what you guys are looking for in a property?
The underwriting really hasn't changed that much, other than what I have mentioned before, that there is a much tighter focus on updated financials.
Got it.
And we essentially ask for rent rolls after you apply for that loan and updated collections virtually every 1 or 2 weeks, right? So it's a very close focus on what is the current performance at the property. So that's what has changed at the underwriting level. At the loans, on the loan side, anyone who has been in multifamily and has done deals as an investor or as a sponsor, obviously has heard about principal and interest escrowing that the lenders, particularly agency lenders, demand. Initially, it included everything in the kitchen sink, including taxes and insurance, but that went away very quickly. But we still have, as many of you know, it's for a full leverage loan, it's anywhere from 9 months to 18 months of principal and interest that needs to go into escrow. And I do not really foresee that goes away that soon. Yes, we have vaccinations that now have been rolled out, but I think all the agencies and other lenders, it's not just the agencies, but certainly they are at the forefront of it. They will take a cautious approach before they are reducing those escrow requirements.
Gotcha. Yeah, we're seeing that as well on our projects. Makes sense. How do we factor in, I guess we'll call it the sporadic income that I'm seeing on our properties that comes with the various state agencies? So we're seeing, North Carolina just relax some of their requirements around the HOPE program. So all of a sudden, we're able to get $20,000 in back rent, this month for the last 4 months, right, from a few tenants. So how do you factor that in, this sort of up and down, sporadic, the higher delinquency, but then maybe a big chunk of money coming in on a random month?
Yeah, if you have these spikes, right, essentially you have written off X amount of rent collections, right? It showed up as bad debt. So initially, over the last few months, we assume in that case that you had an increased bad debt, and now you are essentially recovering it, right? So that's depending on how you accounted for it. That's really how it should show up on your financials. We look at it and we normalize it, right? So we look at it. Okay, what have you recovered? So maybe we have applied a much higher bad debt factor before. So now we can reduce it because we know now you have reduced your accounts payable on the tenant side significantly, and that's only fair to account for.
Got it. Okay, that makes sense. Since we're on the topic of normalizing, I have a personal question because we're in the middle of a refinance, and I want to transition more now towards after the close and how we can work together. But we're in the middle. We've been working with our lender. We've been talking about a refinance for a while, and our numbers, October, November, December, were trending great. One of the great things that our property manager does is heavily incentivizes our managers and maintenance staff for high collections, high occupancy, making those properties profitable. But now in January is when I have to pay for that incentive. And so I have a huge bonus expense in my January numbers, like to the tune of like $17,000 on one of our properties, which takes our NOI from like maybe $75,000 a month to now we're in like $57,000 a month, right? So are you able to normalize that as well? Is that something that you see as being earned throughout the year, or does that really hurt my 1 month NOI?
Yes, so we really look at the income side and the expense side in a different fashion, right? Okay. Similar as for an acquisition, when it comes to rental income, the last 3 months are really the main driver. Okay. That flow into that NOI. On other income, it's still the last 12 months, right? Because you have, particularly with when you have utility reimbursements and all that, they fluctuate, as well as some other income that fluctuates. So that's why it's typically looked at on a T12 basis rather than just the last 3 months. Got it. Now, when it comes to the expenses, they're also looked at the T12 basis, not a T3, but for the full last year. So if you have that bonus that you're paying, obviously your payroll cost in a single month will spike, but it's really the last 12 months, it's averaged over the last 12 months what matters there.
Got it. Okay. Makes a lot of sense. Okay. So you got me a great loan. I've closed on the property. I say goodbye and never talk to you again, right? No, I want to keep talking to you. How can you help me through the ongoing ownership of the property? How should we be talking? Should we never talk? And, obviously at some point, especially if it's a bridge loan, we'll be looking for a refinance. Just talk about how you can help someone that owns a property, an operator, just think about things and look at the numbers as we move through the ownership of the property.
Yes. So if you have a bridge loan, then it's already a given that we continue to talk, right? There are a couple of reasons for that. More likely than not, you will have some issues with the servicer to draw from funds when you write with a bridge loan. You obviously have some funds in escrow, right? That can be drawn from, or if it's not a pre-funded loan, then you still, in order to increase that loan balance, you still need to put in the requests. And you as an asset manager, very often a lender may not like exactly what you submitted to release those funds. So more likely than not, we will get involved at some point in just helping to get these funds released. What is equally important is, particularly with a bridge loan, but even if it's not a bridge loan, to prepare yourself for that refinancing ahead of time, right? Because a permanent lender, as I mentioned before, looks at your expenses over the last 12 months, not just the last 3 months, right? So what that means is that you have to be sure that your expenses get to the level that we believe they can be, and you believe they can be, to get to the best possible NOI. As an example, if you start out with high payroll, and that's not unusual when you take over a property that you have higher payroll and higher R&M, that you are aware of that if that high payroll, let's say 1,500, continues to stay in place, the lender is not going to underwrite to, let's say, 1,200, right? So if you buy a property where the in place owner has a 1,500 payroll, we can argue together with your property management company that you can run it at 1,200 and we can underwrite to that. But once you own that property, we cannot make that argument, right? Because you are now running that property.
Right.
And there's no argument that you suddenly can drop it from 1,500 to 1,200. So in other words, you need to prove over a period of 12 months that you actually can run it at those lower costs. It not necessarily has to be the whole T12, but you only need to show, once the property is stabilized, at least for 6, ideally 12 months, but at least 6 to 9 months, that you are able to continuously run the property at those expenses, right? So that is very important, because that has an impact on your debt service coverage, which has an impact on your loan proceeds, and it has an impact on your valuation.
Yeah, one thing that I've learned over the last few years is that even if you have a 2 or 3 year time horizon with a bridge loan, you're going to renovate a bunch of units, put a lot of money into amenities, whatever, that time starts ticking from day one, and you have got to sprint towards your goals because it goes fast. So 2 years to turn all your units, and you've got draw requests and inspections and all of this to prep for that refinance. It's absolutely critical for anyone listening that you keep your lender involved, because they are, someone like Anton is going to be a huge ally for you in getting those draws out when you run into problems. We ran into a problem with our servicer, and exactly that, right? We had to go back to the person who helped us get a loan and say, like, hey, we need help, and we have to escalate this because they keep changing the requirements on us. We've given them everything they've asked for, and now our draw is 3-4 months late. And these things happen because they're because of for whatever reason. But it's something that we as operators have to deal with.
That's a very good point. So since we talk about servicing and the draws, right? There are good and bad bridge lenders, right? So be aware that just because the terms look great and you get into that loan, the post-closing with the bridge lender is absolutely crucial, that it goes smoothly. There is no bridge lender where it's easy for a borrower, right? They're all pretty tough, right? So it's a tough environment to operate in.
Yeah.
So one should not assume that there is a bridge lender that just gives everything that you want, but there are still the good ones that are fair, and then the other ones that are really not fair when it comes to the handling of draws. Right.
So let's talk then. Any other tips that you have for me as far as, I know I'm in this bridge loan, let's say it's a year out that I'm going to refinance, how when do we start looking at financials again? Like, should I be sending them to you every month? Like, what do I do leading up to that refinance point?
Yeah, so every month is probably at the beginning is not necessary. You can do it, but it's not necessary. Once you get closer to that stabilization phase, and you essentially see, as an experienced asset manager, you see ahead of time what your timeline would look like. So once you feel, I think we have a chance to refinance within the next roughly 12 months, that's when it's time for us really to look at the financials and give you advice of where you need to look out for to get, again, primarily on the expense side, but also on the collection side, where you need to be to get to the loan proceeds that you absolutely need, and hopefully additional loan proceeds to have some form of a cash out, right? One important element too is, particularly when it comes to R&M, do not pack R&M with CapEx expenditures, right? Because it's kind of a pain to clean up your P&L after 12 months, removing all these capital expenditures. It's really much easier to do it properly from the get-go, because every piece of capital expenditures, you may think, well, it lowers my taxes, so it's a good idea, right? If I have it as an operating expense, well, once you come into the underwriting for a loan, that CapEx is negatively impacting your NOI, right? So you need to think of that side too. And we recommend to clean it up really well ahead of time as you go along, rather than having to do it for a whole 12 months afterwards.
Yeah, I think that if you are going to do a project with heavy CapEx, talk to the lender like day one and understand how we should be accounting for these things. We always put our CapEx below the line, and it's something that actually on a monthly basis we're reviewing with our property managers of, is this operations, our plumbing expense went up, doubled this month, okay, is that true operations, or did we issue a purchase order and it became a capital expenditure and then we can move it below the line? And
yes,
it's not, you just need to be constantly making sure that those numbers are clean, and delineating between a true operations expense or a capital investment is something that we are talking about pretty much every day over here.
Yes, it's a very good point, right? And when you discuss it within a month, everyone remembers what they have done.
Correct.
Try that after 6 months or 9 months.
Right. No, absolutely. I mean, another point there for me is, like, we do monthly deep dive financial reviews with all of our property managers, and we look at that. And I want to look both. I compare the month expenses and income to last month, the previous month, but also to our budget and then to our initial underwriting as well. And so we can see where we're growing or changing or different. And then you can catch that early, because to your point, I don't remember. And even a great property manager with great accounting and record keeping, might be hard to figure out 6 months ago, 9 months ago, what that plumbing expense was. Was it for a new HVAC? Was it for that big leak in the wall? Or did we just have a lot of little plumbing expenses? And, now we've lost that money and that knowledge forever. Okay, so Anton, we're going to move towards the end of the show here. This has been so helpful, and I love talking about how we can work together throughout the life cycle of the property, because it's so important, and most people, I think, don't really think about that. We need a loan to get into the property, but what happens after? So this has been very helpful for me, and I know for our listeners. So I'm going to ask you to give us your true multifamily tip. But before that, can you please let our audience know how they can find out more about Peak Financing or you, and get in touch with you?
Sure. So you can reach me at Anton at peakfinancing.com. Our website is peakfinancing.com. I'm very active on Facebook, LinkedIn. Right now, the new thing everyone is active on is Clubhouse. We are hosting rooms on a regular basis there too. Just everyone joining us and talking about multifamily. So that's where you will likely find me too. So that's essentially very easy to reach.
I love it. And Anton's links, social, Facebook page, Clubhouse, could you have a Clubhouse link? I'll be honest, I'm an Android guy, so I don't know Clubhouse yet, but hopefully
Okay.
soon.
Yeah. So somehow they don't like Android.
I know. Well, all the links are going to be on our website, truemultifamily.show, and you can catch up with Anton there and definitely join him on Clubhouse. I might have to go get an iPhone just to do that. I'm feeling a little left out, to be honest. But Anton, this is it. Give us someone says to you, Anton, I want to get into multifamily investing. What is one piece of advice that you're going to give them?
Yes, I think the key advice is focus, right? Focus on a market, focus on an asset type, right? Even within multifamily, decide what you can do and focus on that size and stick to it. What I see too many times, particularly with newcomers, they are chasing that shiny object all over the country, right? They're in Texas, then they're in Florida, they're in Georgia, or Arizona. Whenever they see something online, they are chasing it. It's not going to work, right? You lose your complete focus. You don't build relationships with brokers and property managers and other partners on the ground. You will never find a good deal doing that, right? Just focus in, agree with yourself and your partners where you want to go and what you want to do, and then stick to it and go all in that particular market and segment.
I could not agree more. What a great tip. Thank you. Anton, thank you so much for coming on the show. Love this conversation. Appreciate you. And if you guys like this show, please leave us a rating and review, subscribe to the show, and check out Anton's information at truemultifamily.show. Anton, thanks a lot.
Yeah, thank you, Justin. It was great being with you.
Thanks for listening to another episode. Check out our website at truemultifamily.show. And if you have an amazing story to tell, share it on our Facebook community, and you might just be the next guest on the show. We're also on all other social networks. Just search True Multifamily. I'm really proud to have the show produced by our company On Air Brands. Check us out at onairbrands.com. We also have an incredible, unique podcasting event that we would love for you to be a part of. Check that out at podmax.co.